So I kind of consider myself someone to be in shape. At least I strive to be in, good shape or great shape. And it's really important for me to be in good shape considering I'm in my mid 40s and I have 2 kids under the age of 10 and I still want to be in good shape for them when they're teenage years and, fingers crossed, when they have kids, I want to be around and be in great shape. So it was kind of funny. This weekend, I was spending time with my parents, and my dad was born in 1940. So he is 31 years older than me. And I'm getting more flexible in my 40s. And I was showing my dad some flexibility tests I was doing, thinking, hey, look, I can do this and I can do that. And it's just hilarious because my dad's like, oh. And now you got to remember, my dad is 76. I'll be 46 next month. And not only could he do all the stuff I could do, and I'm not saying I'm the most in shape, 46-year-old, but I'm pretty in shape. Not even like pretty in shape for a mid 40s. I'm just pretty in shape for like a guy. And it's just so funny because everything I was doing, my dad was doing better. And I'm not talking just like touch your toes, but all these things. I just find it interesting. And it's something I wanted to talk about today, not necessarily my dad, but the behavior, really the behavior of investors, but the behavior of male investors, specifically over the age of 60, because there's this number I keep coming back to, and this question I was asked this past week by a prospective client. And I want to share that with you. Hey everybody, this is RC Peck, and this is my weekend podcast. I hope you guys are doing great. So the number, actually before I get to the number, but this past week, a prospective client just asked me, goes, what are you most concerned about, or what are you most worried about? And I want to share with you my answer because I think it's telling for a lot of people. So when he asked me that question, literally the first thing I thought of, like my brain thought of, because as you guys know, my brain thinks in images and works out in images, not in words or letters. The first thing I thought of was an image of a plane running out of runway. And I often talk to people about how when their earnings runway goes away, they act and behave even worse when it comes to their money. And it's the point in their life where they actually need to act the best with their money. And it's interesting in many ways as we get older, and I say we collectively as like guys, men, get older, when we haven't been trained in how to manage our money, when our earnings runway goes away, or when our earnings runway is greatly shortened because of how old we are, and we haven't been trained properly, we tend to make worse and worse decisions around our money. So let me give you an example. Let's say you were 47 years old in the 2000 dot-com crash where the market fell 49%. Well, you're 47, your $500,000 account drops to $250,000, or your $1 million account drops to $500,000. And it's pretty upsetting and angering and whatever-ing. But you say, well, I'm 47. Well, I'm 48. I've got another 15 years to earn. Okay, but then fast forward 8 years, and now you're 56, right? And now you have another 50% correction in the stock market. All right, pretty bad. You don't say I have 15 years left. You say, all right, well, maybe I have 10 years left. Maybe I could work a little bit longer. But now fast forward and you're 65, and you see a lot of instability. Well, what happens is because your earnings runway is either gone away or is going away, we humans, especially if we're male humans, we tend to behave worse and worse around our money. And so when he asked me that this past week, what are you most worried about? I said, what I'm actually most worried about is, men over the age of 60. And I just say that because most of the people who come into my world are men and not women. The women are amazing investors. They just have never been taught that they are. And my answer was, I'm most worried what men are going to do. And, they want to go get something that's guaranteed. They want to get they're looking for guaranteed, and so they gravitate towards annuities that guarantee a 5% income or yield or minimum return. They don't really do the numbers and realize that 5% is going to cost them 1.5% in additional fees. So now it's a guaranteed 3.5%. But what they're doing is they're looking for stability. The problem is, and I want to show you one of the problems, and really maybe the only problem, is we are moving into an environment where interest rates are not going to be on the side of bondholders. Now, if you look at the screen, this is a price chart going back a really far way, back to 1790. But even if we just look at the last 100 years, when this line is falling, right, and this is the yield of a 10-year treasury, a U.S. 10-year treasury, when the yield is falling, the price goes higher. And so what we're doing is we're entering into a point where the price isn't either going to go higher ever again because it's in that sideways topping formation, which we could very well, we're for sure, the 10-year price, the price on the 10-year yield, sorry guys, I always have to think about this out loud. The price on the 10-year treasury has been going sideways for 5.5 years. Now, has it topped out? Guys, we don't know yet, but it's been going sideways for 5.5 years. So it may go a little bit higher over the next year or two, but we don't have another 10 or 20 or 30 years where the price on the 10-year treasury is going to go higher. Now, the reason this is important for men over the age of 60 is that's been the wind at their back, at everyone's back, for the last 35 years, the last 3.5 decades. Heck, if you look at every financial advisor, they've run their entire career where the price of bonds just went higher. It's just like, well, yeah, the sun comes up in the east and it sets in the west. Except that's only been happening 35 years. And the previous, say, 35 years before that, the sun came up in the west and set in the east. So this is not a set thing. And so what I'm most concerned about is men. I know women can do it too, but I'm just talking about men right now. They set themselves up to get into some sort of guaranteed 3% a year return because they're just scared. And I get that they're scared. It's okay to be scared. The problem is, first of all, men aren't allowed to share their feelings, let alone men over the age of 60 or 70. But I'm most concerned about people making their choices around bonds over the next 5, 10, 15, 20, 25, 30 years because of this price chart and because of this belief that we've been taught that bonds are safe, bonds protect. Well, that's been true for 35 years, but as you can look on the screen and this price chart, that's not always true, and yields won't always be falling. And what you're looking at on the screen is yields falling. And this is why some people might say I rant against big box advisors and story-based pick-of-the-month newsletters and people like Tony Robbins, is because they have their information wrong, and it ends up hurting a lot of people, right? I've said for years, Robert Kiyosaki, the Rich Dad, Poor Dad guy, he created more bankruptcies in this country than any single person in the history of the United States. Because he was the one that pushed, real estate, nothing down, go forward, appreciation, go, go, go. And people bought into that, and then they got absolutely slammed. They had to foreclose on their properties, and then they had to file bankruptcy. It worked great when the price was in your favor, when the wind was at your back. But guys, it's not always going to be that way. And so what you end up doing is you don't buy assets, you buy strategies. And the strategies a lot of people are buying are one-way strategies. So in my email, I shared a couple numbers with you. Actually, I shared three numbers with you, 11.4, 10.5, and 11.6. I'm going from memory, but you can look at the email. Here are what those three numbers represent. And instead of me keep saying all three of them, 11.4 and 10.5 and 11.6, let's just round and say 11. So the number 11 is how much worse a bond investor does than just buying the index. And this is whether you look at 30 years or 20 years or 10 years. And the reason I'm not going down to 5 years or 3 years or 1 year is because it gets even worse. So think about that. The average investor who's managing their own money around bonds, which, most people over the age of 60 have been taught that you got to have bonds. Though remember, an asset is not a strategy. They perform 11 times worse than an index. 11 times worse. So if the index did 11% a year, they're doing 1% a year. But on average, that index was doing about 5% a year, which means they're doing about 0.5% a year. And that is absolutely creating more instability and more fear and more sleepless nights for their life. That's the instability. And it's because of they've never actually been trained on how to actually manage their money. So the question is, and I was going to say, the question is, what's the takeaway? But the reason I wanted to bring this up, and the reason why I started with the runway image, is because when you run out of your earnings runway, you don't have your earnings to fall back on anymore. And because people have never been trained properly, right? They just went from the big box world to the story-based pick of the month world. They end up hurting their future even more. So the takeaway on this, at least in the US, it's Easter weekend. The takeaway for this Easter weekend is, guys, it's not assets. What's your strategy? And I'm going to buy bonds is not a strategy, right? Bonds is an asset. I'm going to buy an annuity. Annuity is a vehicle. It's not a strategy. And so people have really never had this distinction made for them before, right? Strategies, not assets. It's not about bonds, not about annuities. It's not about options. And I mean like stock options. That's the other thing. Who buys these option trading systems the most? People who see their earnings runway running out. And so they start looking for the Hail Marys. And that ends up hurting them really badly. And you know, when the prospective client talked to me this week, he said, what are you most worried about? I didn't go to my kids' health or my kids' 529s or my retirement account or my future. I went to, oh my gosh, you know what? I'm most worried about people, men over the age of 60, buying into the idea that bonds are safe, bonds are stability, bonds are something that can protect them. That's been true the last 35 years, guys, but it will not be true going forward. And this is not me doing a Harry Dent or Porter Stansberry scare the hell out of you. I've been looking at the price charts for my entire adult life, and yields will not, you know, they're pretty low now. They could go lower. Of course they could go lower. But we're at that point where, at least in baseball terms, are we in the 9th inning? Are we in overtime in the 10th inning or 11th inning? We're definitely near that 8th, 9th, 10th inning for the bond bull market. And so when he asked me that, and then I saw my parents this weekend, specifically my dad, and he was more flexible and probably stronger than me too. It just made me think about, gosh, this is something that people are living into that's going to create more instability for them, more sleepless nights. Of course, they're worried about when the next shoe drops because they don't have a strategy. They don't have approach. They've never been trained to be prepared for when the next shoe drops. So when it does, it's like, oh, yeah, I just step aside and do this. And that is missing from their life. Hey guys, this is just another step in helping you protect your portfolio and your future. Until next time, this is RC Peck. Hey guys, thanks so much for being in my world. I think a lot about how much worse we collectively do when we don't have that backdrop of our earnings runway. And it really saddens me and scares me for a lot of people. Because, I mean, by the time they've gotten into their 60s, right, they tried the big box and they just watched their big box advisors take their money down with the rest of the market. Heck, even people who were in a safe or age-based fund or a balanced fund, they saw their money fall 40% or more in 2008. Guys, losing 40% of your money does not feel like a balanced or safe way to have your money managed. And so, you know, people are like, look, I don't need you to lose my money or just have it fall with the market. That's not right. And then they ended up in the story-based pick of the month world, which, just so you know, guys, those newsletters are written by the highest paid nonfiction writers on the planet. Guys, if you went to their office, you would see shelves of psychology books on how to manipulate and influence people. You would see handbooks saying, whatever asset is hitting lifetime highs, that's the service we're going to sell. Oh, oil's hitting $140? Let's sell an oil service. Oil's fallen to $25. Let's sell an oil service. It's not in your interest. These are the highest paid admin. These are the highest paid nonfiction writers on the planet. And they know every trick in the book to capture the attention of your brain and your amygdala and your limbic system and scare the hell out of you, which sends your prefrontal lobes offline and your amygdala takes over. That's why people own 4, 5, 6 newsletters. They just keep buying and buying, hoping that the buying relieves the hope or fulfills the hope. And so I get it. They don't trust themselves anymore, and they don't know what to do. They're scared. And yet when they look and they notice, they go, oh my gosh, I've actually never been trained. I've just been trained to buy investment newsletters. And I know that doesn't work anymore. So it's just a food for thought, and I had that conversation with that prospective client this past week. I hope you guys the best. I'm visiting my parents this weekend, which is great to see them. My mom is doing great. It's great to be around my parents. Thank you guys for being in my world. I appreciate you, even though I may not have met you individually, but I do appreciate you. So thank you, and I will speak to you guys next week.